The market has sold off over 1,000 points in the last week, but it's hard to ignore the fact that we've already hit 37 new all-time highs this year alone. Will we make it back to those highs? Honestly, I have no clue. But if you're someone looking to take advantage of these dips, there are a few key things you need to understand before jumping in. That's why I sat down with an ex-prop trader to break down how to set up trades during market pullbacks, how to recognize when momentum is actually shifting, and what signals to watch for before stepping in. After that, you'll hear from a macroeconomist who explains why paying attention to the US dollar matters and why we should even care what the dollar is doing when gauging overall market sentiment. When markets sell off, everyone's talking about buying the dip. But the reality is, timing, structure, and risk management matter a lot more than people think. So I sat down with Jermal, a former prop trader and current options expert, to get his take on how professionals approach short-term pullbacks, especially when using options. Before we go deeper, I want to touch on something every trader thinks about when the market pulls back. How do you mentally position yourself to trade this right? Because let's be honest, buying the dip sounds easy, but once you factor in timing, strike selection, and decaying premium, you realize there's some extra thought that needs to be put into it. For example, if you think something like QQQ or the Nasdaq is going to rebound in 7 to 14 days, do you buy calls or sell puts? They both let you get long, and that's where the confusion comes in. Which one makes more sense in this kind of pullback? And then there's a timing problem. When traders see a dip, they either jump in too early or too late. Is the real mistake entry timing, strike selection, or how they manage the position once that premium starts bleeding? What about traders with smaller accounts? Say you've only got $1,000. How do you position for a dip without over leveraging or blowing through your buying power? And even if you do catch the move right, do you go in the money, at the money, out of the money? What makes sense when you expect a short-term bounce? These are real problems traders face every single week. And here's what Jermal had to say. If you believe an indice or an ETF like QQQ will rebound within the next 7 to 14 days, do you prefer to buy calls or sell puts?
Something like QQQ, more than likely, I'm looking at selling put spreads because it's an index/indice, and I usually think that those might have a bounce on the order of 2 to 3%, which is sizable, but it's not the kind of bounce where I would want to buy calls expecting a massive move to the upside.
In your experience, what's the biggest mistakes that you see traders make when they're trading short-term dips, especially using options? Is it timing the entry? Is it something like selecting the strikes? Or could it be managing the position as your option premium is running out?
All three are pretty tough. If I had to choose the biggest one, I would say the timing of the entry. I think early traders want to just be all in. You want to push all your chips in immediately on what you feel is going to happen. I've certainly been victim to that at times in my trading career. And I think being able to time it slower, being able to scale into a position, which I think requires patience. It's hard for newer traders to do, but scaling into a position, a couple of units, maybe one or two. Say you want to do 5 overall, do 1 first and see how it reacts. Do 2. Things might fall further, and then you don't have the ability to scale in if you went all in the beginning. So give yourself some time, I think. And I think that's the biggest takeaway in a lot of situations, giving yourself time and scaling in slowly and being small.
If you only had like $1,000 trading account, how would you buy the dip?
I think you got to think in terms of, again, back to size and timing. I think you got to think in terms of sizing. $1,000, that means if I do a $100 position, that's 10% of my portfolio. And what can I do with that? What kind of names am I trading with that? You're automatically taking a lot of names off the board just from that size alone, unfortunately, but it's true. I mean, it's hard to trade a name that's $500 or $600 or $700 with that type of sizing. So I think you got to give yourself further time. One thing, you got to go multi months out and try to find something, finding a stock size that actually works for you, and therefore option sizes that work for you. And think about it in terms of percentages. How much am I going to use in my portfolio in this trade? Is it going to be 1%? Is it going to be 10%? If I'm going in with $500 in one trade, I mean, that's half my portfolio, and you're going to live and die on that position. So you have to think of things in terms of percentages.
I wanted to zoom out and look at the bigger picture, because knowing how to set up a trade is one thing, but understanding the sentiment driving the market behind the move is just as important. That's why I brought Ilya Spivac, a macroeconomist who can break this down into plain language. We talked about the US dollar because it's one of the best gauges of risk sentiment across global markets, yet most traders overlook it. I wanted to understand why the dollar matters so much when it comes to reading the market's mood. So I asked Ilya a few key questions. Can you see hints in the dollar that tell you when the market might get jumpy soon?
Absolutely. So the dollar is one of these more interesting instruments. It waxes and wanes in its relationship relative to the market's risk sentiment. And so it's not so much that the dollar is one thing or another, but it is that you can look at the dollar and see how it's behaving, especially relative to other currencies and relative to other assets, and get a sense for what risk sentiment in the market is. And that, of course, gives you insights on other things happening as well. So there's a great insight from economist Stephen Jen, who sort of popularized this, is the idea of the dollar smile, which suggests that the dollar outperforms when the economy in the US is doing really well against the other major economies or really poorly, and that it's down when performance is kind of middling. Now, that's not so important as far as economic growth per se, but it does tell you that it can play these dual roles. So if you're looking at the dollar and you're seeing, oh, stocks are declining at a time when the dollar is rising, that's usually a sense that there's some sort of significant risk aversion going on because capital is coming out of assets and going into cash. And make no mistake, the dollar is a safe haven asset in any kind of significant market sell-off. So you get a situation where you see the dollar rise, especially if it's rising against higher yielding and more cyclical currencies like the Australian dollar and the Canadian dollar, and maybe it's a little bit weaker against the yen and the Swiss franc and defensive currencies like that. You definitely can get some insights and say, okay, well, this is the kind of configuration that would be consistent with higher risk assets like stocks or Bitcoin having downside momentum and being under pressure and maybe continuing to go that way.
If the dollar starts getting stronger but the VIX isn't moving, is that weird? What does that mean?
It's not weird. It's not weird because the dollar can have these different relationships. So let's consider, for example, the situation in 2022. You have a situation where the Fed is raising rates, stock markets are falling all year, but of course, at the same time, you have the dollar rising because these rises in interest rates make the dollar more attractive because it yields more to its holders than other currencies. And so when interest rates rise, the dollar gets attractive. Now, is that enough to extrapolate that the dollar goes down when stocks go up and the dollar goes up when stocks go down? No, of course not. Because you could just as well have an environment where they go down together. For example, take a look at the Liberation Day situation, late March, early April of this year, where the market became generally concerned with US-based assets, and you had stocks, the dollar, and treasury bonds going down at the same time. You could have a situation where stocks and the dollar go up at the same time. If there's a significantly strong economic expansion, good for earnings, probably encouraging the Fed to raise rates because they're concerned about what the economic boom would do for inflation. So you can have stocks and the dollar go up at the same time. So if you don't have a clear relationship between the dollar and the VIX that's consistent, those cross-market relationships that we were just talking about, they become most interesting because you have to look at what kind of dollar you have. So if the dollar is going up and the VIX isn't, is the dollar going up at the same time that stocks are weakening? Is Bitcoin weakening? What's the dollar strengthening most against? Is it the Aussie or the yen? And if it's the Aussie, well, then you have to start thinking, well, maybe the VIX is going to pop. Maybe it's a risk-off kind of a vibe. If it's the yen, maybe not. So it depends, and context really matters.
Whenever we're viewing the dollar relative to another asset, is that where we gain our context? With where we could just be looking at the dollar itself, is there not much context to derive out of that? Do we need to look at it a little bit more, relative to other assets?
Well, anytime you think about quote unquote the dollar, it's really important to sort of define what you're saying because currencies don't exist in a vacuum. the only way that you can really say what is the dollar. Is it the dollar's exchange rate against this currency? Is it against that currency? Is it against a basket of currencies? And so when you look at, for example, something like the dollar index, DXY, what is that? Well, it's a dated basket made out of currencies made to give you an average view of the dollar, but it was made before there was a euro. And so now most of that basket is just euro. So what is DXY? It's just the euro US dollar exchange rate upside down. So it matters what you're talking about. I think the most insight you can get is in looking at, let's say, how the dollar is performing against currencies that are more linked to economic growth relative to those that are more defensive. So saying, okay, how is the dollar performing relative to, let's say, on one side, Australian dollar, Canadian dollar, and on the other side, euro, yen, pound. And that gives you a sense of what kind of a dollar is this? Is this a risk-off dollar? Is it a risk-on dollar? Is the dollar rising at the same time that bonds are falling and so yields are rising? So is it rising for reasons where people want to hold dollars because interest rates are going up and that's a return on holding dollars? Or is it rising very potently, let's say in 2008? Stocks absolutely crater. Interest rates go to zero and the dollar soars. Why is it soaring? Because interest rates are going to zero? That seems counterintuitive if that's what you're focused on, but it's not going up for those reasons. It's going up because it is the most liquid currency in all existence, as far as we know. And so when people divest from things and money goes to cash, where does it go? Which cash, right? If I'm cashing out of my stocks, bonds, commodities, whatever, what's my cash of choice? Obviously, it's the most liquid one because I want to be able to reinvest back smoothly without losing a ton of money on the way in and on the way out. If I were, let's say, to be shifting my capital into an illiquid currency, well, then I better be the first one to have that idea. Otherwise, I'm buying very expensive. And if I'm shifting into a less liquid currency on the way back out of cash back into assets, I better be the first one on that idea too. Otherwise, I'm selling the currency very, very cheap. So the dollar is uniquely liquid, and so it can take a lot of capital coming in and a lot of capital going out without moving all that much relative to other currencies. So it's important to look contextually and say, well, what kind of dollar is this? How is it performing relative to some of these other currencies that occupy sentiment extremes? How does it correlate with yields? How does it correlate with stocks? How does it correlate with gold? And what kind of an environment is it in?
So Ilya, I'm a new trader investor. What's some advice for how much weight or attention we need to be putting on the dollar on a day-to-day basis, a week-to-week basis, maybe a longer-term perspective?
I think you have to pay tremendous attention because the dollar is a reflection of the underlying cost of money. And that's the decision that matters more before anything else. Before you go, okay, I should buy that stock or this stock. I should look at this sector or that sector. Stocks in general at the index level are biased higher, biased lower. All of that, before you make any of those decisions, you first have to make the decision, do I want to place a trade at all? Is this even an environment where I should be deploying capital in markets? And that's going to be largely a function of the Fed, of the path of interest rates. And of course, the dollar is a direct reflection of that. So looking at the dollar might be the most important thing. If you want to get a good sense on what the price action is telling you about the market mood and whether you should be looking at this thing or that, step one, in my mind, is looking at what's the 10-year bond doing and what's the dollar doing.
When the dollar goes up, does the market get too scared or not always?
So people oftentimes get themselves into a little bit of a logical trap because they start to think about market relationships, this asset to that asset, in causal terms. So they think, well, when this happens, that causes that to happen. And that is almost always the wrong way to think about it. Because as we know, and as we constantly get beat over the head with in the markets, correlation is not causation. Just because things are moving together, it says absolutely nothing about whether one is causing the other, or indeed the other way around.
Why do we think in such a cause and effect naturally in the
I
market?
think it's human nature. I think people like to have simple answers, and they like to say, for example, well, when the dollar goes up, stocks go down. Well, no, not really. There are plenty of examples when that isn't the case. The question is context. Is it certainly the case that sometimes when stocks go down, the dollar goes up, and sometimes when the dollar goes down, stocks go up? Of course, because the dollar is this kind of risk-on, risk-off asset. You can absolutely have a situation. Just think to what we saw this year. We've seen the dollar weaken. We've seen the dollar strengthen. We've seen stocks weaken and strengthen. And they've had sometimes relationships that are parallel, sometimes relationships that are inverse, depending mostly on what the outlook on interest rates is. If the dollar is going up because the economy is strong, and the Fed is going to raise rates because they're going to be concerned about inflation in a strong economy, stocks are probably going higher too. If there is a risk-off situation, especially a critical one, think COVID, think '08, where you have a market collapse, capital is fleeing to the dollar. Now, is that rising dollar the reason why stocks are going down? Of course not. So you go down the list and you go, okay, let's look contextually. The dollar is doing what it's doing in the context of what? Are stocks going up or down? Are interest rates going up or down? What's happening with Fed policy expectations? What's happening with gold? What's happening with bonds? And when you start to put these things together, you find what kind of dollar you're looking at. And generally, what I like to do is look at scenario themes. So when you look at and you go, okay, this is an environment where the dollar and the yen are up, stocks are down, interest rates are falling. Risk off, very clearly. And when you put those things together, you go, okay, this is a scenario like that. And then when you see, okay, this is a scenario where, like in 2022 again, stocks are going down, dollar is going up, interest rates are going up. Okay, this is a rate hike cycle that the market is uncomfortable with. So it's risk off, but it's positive for the dollar because rates are going up and it's more attractive to hold it. There are environments like in April of this year where the market is just generally negative on U.S. assets, and so stocks and the dollar fall together. It's really important not to get stuck in these paradigms where you say, oh, well, this always happens when X. That's almost never the case. Correlations wax and wane between all assets. Sometimes they become inverted, sometimes they're direct, sometimes there's no correlation. And looking at what those relationships are can be very, very telling about what the macro environment itself is doing and where it's going.
At the end of the day, there's always going to be variables to consider when you're looking to buy the dip. And there's plenty of different ways to do it. But no matter which approach you choose, the most important thing is always the same. Manage your risk. That's what keeps you in the game long enough for these setups to actually matter. And if you're looking for more trading resources, be sure to check out tastylive.com, like, subscribe, and we'll see you in the next one.